Hi, everybody. So we're waiting for people to chime in and hope you guys doing well. Ben is connecting, which is super exciting for us. Ben, how are you?
Good. There we go.
Chill and beautiful. One of my favorite radios it's a radio chill on Sirius XM and the satellite radio. And they
Nice.
always say freshly chilled music, which is absolutely amazing in my opinion. So,
Love it.
Ben, can you walk us through a little bit? So, where you at? How's the weather like? And what are the fun stuff you about?
Yeah, so I'm here in Kansas City, and you and Nikita were just here last week, so it's fun to have you here. It's going to be pretty hot today, but a little toasty in the Midwest here. But yeah, I've been here for a long time. Our kind of core team at Aspen Funds is here in Kansas City, and love it here.
Thank you for having us. It was just a great trip, right? We walked through the previous deal. It was amazing experience seeing that change. It was a lot of changes made for only 6 months time. Why we here today? Again, I'm going to talk a little bit about myself. I'm in Oxnard, California, by the beach because I'm anticipating the July 4th weekend. So we usually go with my family to the beach, and I'm connecting from Oxnard, California, which is super exciting. Again, why we're here and then what we're trying to achieve with that webinar, it's actually dedicated to the credit fund, the private credit fund. And then what is that? Why it's worth using credit fund as an investment vehicle, and then how to receive a dividends using the credit fund, what kind of projects we invest in inside of the credit fund, and lastly, it's a business model of the credit fund itself. Just a brief description of what we're going to be going through. What we're going to start with, Ben, if you can introduce yourself, a little bit of the background, and then what are you doing now, and then how you guys structured as a company.
Sure. So I'm the Chief Investment Officer at Aspen Funds. Aspen Funds, we've been around over 11 years. We've been running a lot of different types of funds. We've been running open-ended debt or credit-focused funds from the beginning, which this fund is really an offshoot of from that background and expertise, which we'll talk more about the strategy. But that's really our team. We have about 25 full-time staff. I'm one of four partners. And my background is, been in finance my whole career. Spent most of my career before Aspen in banking. I was a commercial banker, was an underwriter for a period of time, and then joined Aspen about 7 years ago, and really kind of came over to help run the finance side, but ended up loving capital raising, building the funds, and really helped our team and our asset base grow to we're about $500 million in assets under management right now. We've raised over 250 million of equity investment capital from investors just like you. So we have a lot of investors. We have a lot of channel partners like Avista that we work with to bring what we think are best in class investment opportunities to the retail investor channel, which is really exciting.
Thank you, Ben. Thank you very much. I'm going to talk about myself a little bit, right? It's again, we're Avista Fund, and I'm co-founder. I have my partner Nikita as well working with me alongside and our team. And I started as a professional athlete. My probably life, I would say, my first life was professional athlete. I played at the highest level, and then sure enough, after the tough career rate in sports, I moved over to the business ownership, and we opened one of the biggest businesses in Los Angeles in our category. And then 14 years, it's been like a journey. First of all, it's unconscious investment in real estate. And I started back in Russia. So I own multiple units of the residential units and manage them myself. And then surely enough, I scale up that portfolio. And then in a time, I moved to the larger and bigger complexes, apartment complexes, and we invested in 20 different deals so far right now. And working with Aspen Funds for the last couple of the deals, it's been like nothing but a great experience for us, and performance is unbelievable as well. And now we're working together on private credit fund, and we want to take a time and talk about the myth about the credit funds. It's always institutional investors. So it's something huge. It's not reachable. And people, when you start talking about that, people like intimidated, like, I can be part of it. Yes, you can. Yes, it's possible. So, and we want to talk about that a little bit. And Ben, can you tell us a little bit why and how it's even start to become possible? I don't feel like it's been a long time. It's like recent. I'm talking about 15 years when the people start, oh, there's a private credit fund. You actually could be part of it. Can you correct me if I'm wrong here?
Yeah, absolutely. So yeah, in a broader sense, access to alternative investments, which are funds like this, other types of real estate, have really been limited to a small set of ultra wealthy investors. Unless you had the right connections at the country club, you probably weren't seeing a lot of these deals because the regulations prohibited it. In 2012, there was a regulation that was passed called the Jobs Act, which was a big regulation change. But one of the things that it did was allow increased access to funds like this, to where we can actually have a conversation having never met and actually work with accredited investors. And so that's really cool at a high level. And if you kind of zoom down into private credit itself, it's actually a very large subset of the overall investment capital being invested in the institutional realm. And so this is an asset class that's been well developed. A lot of the things we'll get into later have been done at a very high level with large firms for decades and decades and decades. And it's generally been harder to invest in these types of funds because, one, they're generally limited to a very small subset of people. And then two, the deals are very, very big generally. So it's hard to go and get into a deal for only $100,000. You got to have millions and millions of dollars to be able to invest in these. And so what we're trying to do is we found a very unique opportunity in a smaller part of the market. And we're also allowing access to retail investors, high net worth investors, alongside of some other bigger check writers, family offices, and institutional partners that we have in this fund as well.
Yeah. Thank you, Ben. And one other thing, so if you guys watch until the end, we're going to give you like a little bonus. We won't say for now what is that, but you guys need to watch it through the end and then you'll get that real quick. So the second myth is, or maybe it's maybe confirmation, I would say, more than anything. So do you think the private credit fund is structured like a mini bank, I would say, or the type of bank when you pull the capital together, then once you pull that capital, you start to actually allocate to different assets, I would say commercial assets in this case. So does that feel like being part of like private banking or a private bank or something like that?
Yeah, it's interesting, the comparison, because in a lot of ways, we're not a bank in the sense of we don't take deposits and then lend those out as loans. But what we do is, in a lot of ways, take market share from banks, all right? Because what's happened is in the banking world, there's been a big consolidation of banks. A lot of big banks are acquiring smaller banks. There's a lot fewer banks now than there was a decade ago and there was 20 years ago. And what it's doing is it's creating less competition. They're getting more conservative. They're pulling back, only working with much larger operators, larger investment groups. And it's created a pretty big gap in the marketplace for capital. And so the great thing with us is we're not a regulated bank. So it's actually a great thing because we don't have to abide by the very stringent regulations of banking. It allows us to be more flexible in how we help our borrowers and our sponsors that we work with to provide a really, really helpful investment vehicle for their deals, but also earn really good risk-adjusted returns while doing that and protecting our capital and kind of taking the place of a lot of traditional lenders.
Yeah. Thank you, Ben. And then I had one fun fact. So I'm talking to one of the potential investors, and she's actually working at the bank underwriting commercial properties. And I'm saying, why is your bank is doing that? Why do you have such a division in the bank? And she's saying, because we split on three things. One is consumer credit. The second one is going to be business loans. And then my division is commercial properties financing. And I'm saying, yes, you're doing this for your bank, but you never thought it's possible. And again, this is the bank, like it's employee of the bank for 20 years, but you never thought it's possible in your own portfolio, in your own financial goal and decisions of what you actually do, because she never knew it's accessible at this point. And then again, we want to go through that myth saying it's all institutional capital, it's never been accessible. No, it's possible. It's possible. You guys could be part of it as well. And the last myth, it's you could be more protected. You could be investing in a more protected way, I would say. And then I think it's related to the stack, the capital stack. Then we go from the top to the bottom when you have a common equity, which is again, the biggest and the largest risk you can inherit for yourself when you go into the common equity, into the deal. And then we said to ourselves where we can be present, but in a more protected way, how we can protect investors, especially going into that turmoil, which we just faced the last couple of years when we go into the high interest rates and the credit tightening. So we said, okay, we can go lower in capital stack. We cannot become senior debt, right? A lot of times, because again, there's a banking system, and then what they want to do, they want to invest the most secure way possible. With that comes the risk. It's the less risk possible, but again, so this is what you get. You get only 6 to 7%. So we want to get more, a little bit more return, risk adjusted, better risk adjusted return. That's why we want to sit right next to the senior debt position. How we can be present in the secure mezzanine loan, or maybe like private equity financing, or it could be like a bridge loan, which is again have a more priority compared to the common equity. Is it true, Ben? That's what we're talking about here.
Yep, you got it. You're exactly right. So, private credit is a very broad term. It can mean a lot of different things. In our case, it generally means what's called mezzanine debt and preferred equity. Now, we're generally not going to be a senior lender. And so there is a place for banks. And I'm not saying banks are bad at all. I used to be a banker, so that's my background. And I think they'll continue to be a core part of the capital stack. But the leverage rates have come down. It's become more expensive with interest rates going up. And they're also becoming more conservative as they're, going through this credit cycle and having a challenge getting payoffs from them. So what we're really doing is kind of fill in this middle part. We're behind the senior mortgage, but we're in front of the common equity. And so we can earn much higher, what we believe, risk-adjusted returns than just, going to straight debt or straight equity, but also have some control, have some protection to where we have priority over the common equity investors, which is what most people invest in when they're investing in real estate. They're investing in equity. And so when we come into a deal, we get priority over those investors. We also can negotiate certain control provisions to make sure we're protected and can protect our investment.
Thank you, Ben. And then we're going to go to the next section. And the next section is a little bit about the credit fund and why we think it's a great time for now. And we want to start with a couple of reasons, Ben. So what do you think, why it's a perfect timing? So when we speak about timing of that strategy, I would say, and market trend, which is on market right now.
The chart you have here is basically a survey of lenders and basically saying, hey, what things are impacting your ability to lend right now? And you can kind of see the combination of all these different factors: interest rates, property values, different fundamentals of the market, maturing loans, inflation is a big one. And the reality, like we've been talking about, is we kind of have these two different things going on. So on one side, we have the banks, the senior traditional lenders. They're pulling back a lot right now. They're very risk averse because they don't make a whole lot on the money that they lend out. And if they have any losses, it's very impactful to their bottom line. And they have extremely high regulations that are constricting the ability to lend. Not to mention the whole kind of issue going on in commercial real estate, and not really office so much because we're not lending to office, but in, say, multifamily, which is a core opportunity set. There's a lot of banks that are extending loans. They're trying to help their borrowers make it through this kind of downturn. And what that's doing is basically kicking the can down the road for them. And what banks do is they rely on those payoffs of those loans to then lend new money to new borrowers. The problem is they're not getting those payoffs, so it's reducing the available capital to lend. So they're getting very, very strict on that. On the other side of it, we have a lot of equity investors, a lot of common equity investors that have been in deals that are not performing well, or maybe they've lost some money, or maybe they're just concerned about this current environment and they don't know what's going to happen. They don't want to invest. So you have banks that are pulling back. You have equity investors that are not wanting to write checks. So we have this bigger gap in the middle that I was talking about of where what we call kind of gap funding, the kind of middle part of the capital stack, where we can come in and really get the best of both worlds. We invest money generally as preferred equity or mezzanine debt. We get really nice returns. We're generally getting between 16 to 18% gross returns on the investments we make. And then we have different provisions that we can negotiate to make sure they perform. If they don't perform, we can take it back on. So there's a lot of things we can do. I think that's why right now is a great time. It's just this tighter credit market is creating a lot of opportunities. And you kind of jumped up here to the chronic underinvestment in housing, because at the end of the day, right now, things are constricted. We have a lot of supply of new development in a lot of markets. We have a lot of challenges hitting certain sectors of real estate. But the reality is, if you zoom out and forecast for the next 5 to 10 years, we are still going to have an undersupply of housing needs over the next several years. And we believe a long-term investor mindset is going to be very beneficial as we kind of get through this cycle. Now, the other piece here, challenged operators create better buying opportunities. Because a lot of deals are struggling right now, a lot of deals are purchased with bridge debt, which we can get into if you want, but it's a little of an aside. It's creating opportunity because a lot of distressed sellers are being forced to liquidate right now. So what we're seeing is actually a great opportunity for new buyers to come in and to be able to capture and buy properties at a discount to what they were trading at even just a year or two ago, and purchase that at a much better value. And all of a sudden the numbers make sense. And all of a sudden the deal can actually move forward in a positive way. And we've talked about the priority of payment. That's a big benefit, capital protection. Well, the other great thing too is we require a current portion of that 16 to 18% that we earn in an investment. A portion of that they have to pay us in cash every month. And so that requires them to generate cash flow or get to generating cash flow very quickly to be able to pay that. And what that does is allow us to pay our investors nice cash flow, because investment right now, it's difficult to find deals that are cash flowing. And as an investor, it's very important to have a portion of your investment portfolio in cash flowing opportunities. And so that's one of the big benefits of private credit.
Thank you, Ben. Thank you very much. And again, just a brief point of where is the actually private credit fund will be investing money. And again, the majority of it will go into multifamily, because we all know, we research, like we got a lot of partners, a lot of deals coming through multifamily. And secondary could be some different type of commercial real estate as well, different type of assets. But again, the big focus and the big opportunity is there because of that bridge financing, because of that environment of the capital markets, and they going through the cycle of distress. So the people get really hit bad by those interest rate payments, and they cannot service the debt. They cannot. Just monthly payments are not affordable for people. They need to do something with property. And then that's where we come in place. And again, we want to get that secure position. It doesn't mean it's a bad deal. It means they're going through the tough time to refinance that deal. And the people are still living in the property. The people are still paying for the rent, but they need that chunk of equity to come up and close that gap. And again, we're very strategic. Why? Because we're not going to give you 10 million. The deal is 20, right? We put like 1 to 5. And then in the beginning, it's only 1 to 3 million more than that. And that way we really secure above the senior debt and right below the common equity. If something happens, we still have that big cushion of the common equity on top. I don't know if it makes sense, but hopefully it does. So next thing is, what is our target portfolio? I know it's a balance of different things, but again, it's mezzanine debt. It's going to be preferred equity financing. What's the third option, Ben? What is going to be the third option for us?
So, preferred equity and mezzanine debt, you're generally not going to have any security to the property, meaning you're not going to have a lien against the property. You will, in mezz debt, have a lien against a lot of times the management company or the controlling entity that you can take back. Or preferred equity, you have kind of springing control rights. But the other kind of piece of it is bridge loans. And so these will generally be secured. This would be kind of what you were saying, where there's kind of a gap in an investment property, but it's a short-term gap. So one common thing we see is, because it's hard to raise equity, and maybe if they have a short time to close, they need $1 million to close a project, but they have $1 million coming in equity. It's just not going to be there in time. So we can put together a short-term note to help them kind of close that gap and get paid off very quickly. Another example is, hey, we have some land, it's entitled, we're ready to start the development on it, but we don't want to go and get construction financing until we're kind of teed up and ready to go. So can you guys give us a land loan to purchase this, to kind of bridge us until we're ready for the construction financing? Those are usually lower leverage, but a lot of times we can be first position. And we also sometimes have a line into future opportunities in that particular deal. So those kind of target portfolio is a nice mix of that. And with preferred equity kind of being the core of it, that's where the real most of the opportunity is right now. And this we anticipate might shift over time because this is an open-ended fund. We anticipate running this fund for many years. And so as it grows, as the portfolio develops, this may shift, but that's at least right now a target of where we see this kind of landing.
Excellent. Thank you, Ben. Absolutely clear on that. And the next one, we want to talk about business model. What does that actually looks like and how you can get in, how you can get out? Again, so investment submitted. Let's make it super simple. Let's go over the timeline. So we got day one, you submit investment, and then you got 3 months of placement. It's a period when we place the capital into the deals. So after 3 months, the capital has been placed and you start to receive your distributions. The distributions will go monthly into your account and you can check the progress, right, in the portal. And then, so we got a lock period for 24 months. What does that mean? So once you're in the, let's say, month 21, so you can submit the request to exit investment, and then within 90 days, you guys will be eligible to withdraw the funds. So we'll try our best to give us some 90 days, and then we'll work on that, and we'll give you funds back. But that's a general model. And we want to go over the share classes. We got multiple share classes in that investment. If you guys want to invest right now, please click on the link and connect to me on the Calendly, right? Or maybe go directly on the portal and you can just make your choice on the class shares and make an investment. There's class A, we got $100,000 investment. It's a 6% pref. And then we got 70-30 split LPJP. And then total target return, we got 11 to 12%. Target net cash yield, it's going to be 8 to 11, and target compounded return for the people who wants to keep the money without withdrawing, you want to compound your interest, it's going to be a little bit more. It's going to be a little bonus for you guys to get a little bit more. The asset under management fee, and on a B class, it's going to be a little bit more. So you need to come up with a larger number. So it's $1 million. So it's going to be profit return of 7%. And we got 80-20 split. A little bit better economics there, and target net total return will be 12 to 13, and you're looking at the cash yield of 9 to 12. Target compounded, if you want the option, like compound money, I don't want to take him, I don't need the distributions right now, I trust you, I'm comfortable, you guys, so keep it in there. So it's going to be 12 to 15%, and again, asset under management 1.5. So for the 5 million above, so we're going to get the special terms, we can discuss that. Again, you guys click on a link if you want to invest, and you can go directly to the portal as well.
This is different than a lot of maybe syndications or other funds you've seen that are closed-end funds, meaning they raise capital for a short period of time, and then they go purchase a property or a series of properties, and then execute that strategy over a few years and then exit those properties. This is very different because this is an open-ended fund. And I want to be really clear because it's different than what a lot of people are used to, in that we expect to operate this fund at this point into perpetuity. We're not planning on shutting it down. We're always going to be raising capital. And so what that means is we have that liquidity program after a 2-year lockup period. You can get your money out with that notice period if you want, but you don't have to. You can kind of keep it rolling as long as you want. Like I said before, we have other open-ended funds that we've been running for over 10 years. And the intention is it's a great place to stick money and just let it grow over a long period of time, with having some optionality if you need liquidity at some point to be able to get that. And so here you had to have the total return and the cash yield. And I want to just be really clear here because a little bit, some people have had some confusion there. So if you think about what we're generating, like I said earlier, we're getting that current portion of our return from the investments. Then we also have a back end portion of our return that is accrued, but it's not paid out until the property refinances us and pays us off, or sells the property and pays us off. And so we get kind of a big profit event at the end of that particular investment. We also get some nice profit along the way. What we do is we will try and send as much cash back to our investors on a given every month. Every quarter, we'll send additional distributions on some of the additional profit that was generated. And so you get a combination of getting that cash flow, And then you'll also get the value of your account will go up by what's we kind of call the accrued but unrealized portion of your account. So we'll still be earning that return. We haven't got it paid in cash yet. So I'll just increase the value of your account. So every quarter you'll see, here's how much cash you received, and here's the value of your account going up. And at the end of the day, if you ever liquidate your position, you'll get the value of your account value come back to you then, and you can realize it then. If you compound, you're basically taking all the profits you're earning in that quarter and you're buying more shares, you're increasing your share balance, and that will continue to compound over time if you want to, which it can increase your returns.
It's a great point. Thank you, Ben. We want to go into the next section, which is going to be the question and Q&A for us. And if you guys have any questions, please feel free to drop them in chat. We're going to come up with some interesting. The first one I have, what are the main risks of the private credit fund? And we discussed that multiple times. It was a lot of different investors. I think one of the biggest ones, it's a black swan event. So when the deals are not performing, I'm talking about when the project is not performing, meaning there's something happened to the market, right? Or to environment, people just left the places where they live. For example, if we talk about multifamily, and that's going to be probably one of the biggest challenges when the project is not performing. But then there's anything else you're thinking through, Ben? So what is going to be like the biggest and the largest challenge by far?
The biggest risks are these at the end of the day are generally going to be equity. If the deal falls apart, we don't have any property that we can go and foreclose on, right? The bank can. So we have more risk because we're an equity investor. We're preferred, but we're still equity. And so it's important to understand the reason we're able to generate higher rates of return is because we are equity, not debt, in a lot of these scenarios. Now, excuse me, we will be mezz debt sometimes and bridge debt other times, but a large portion of it will be equity. So from my perspective, it's much safer than a common equity investment because you have lower risk on your capital being protected. You don't lose any money until all the common equity investors are wiped. Also, in a fund model like this, there's a lot of diversification. So if one deal goes bad, it's not going to tank the whole fund. Now, we don't anticipate the deal is going bad, but that's always a risk. And we have, before it even gets to that point, we have a lot of ways we can protect our position to where if one of the borrowers or sponsor group stops paying our current portion of the return that we're owed, we can actually many times remove them as a manager. Now, it's subject to the senior lender approving it, but they have already agreed to these stipulations in our operating agreement to where we can basically fire them and take over the management of that property. Now, like I said at the beginning, we own over $500 million of real estate and debt. We have assets in a lot of different states, a lot of different metros. We know how to manage these properties if we have to. The other side of it is we can force a sale. It's called a drag to market or forced sale. So if they're not performing, we want to basically hit the detonate button. We can force them to sell the property. Many times there'll probably be a loss for their investors, but we would likely come out with all of our capital. So there's many ways to protect it. You kind of have a pooled investment vehicle to where you're diversifying your risk across a lot of different investments. And then within each deal, we're protected in several different ways from something going bad.
Excellent. Yeah, that's great. Thank you very much, Ben. So the next one is, I think it's a pretty common question, how investors' capital is protected. So if we're talking about, it's probably a similar question to the risks, but again, how it's protected from the maybe legal standpoint, where they can actually go, how they can, I don't know, how they can claim whatever owns to them, it's going to be theirs.
Basically, in every deal that we do, say if it's a preferred equity, for example, we're not going to have any collateral that we can go collect on. But what we can do is negotiate priority rights. So basically, in any deal, there's a waterfall, right? So a cash flow waterfall, a capital event waterfall. So when money comes in, where does it go? How does it get split up? Well, in every case, we have to get paid off 100% before the investors can get their capital back. And so we're automatically protected because we are in a priority position over the common equity. The other things that I mentioned before is we have certain what's called springing control rights. So if they go into default on our investment and don't abide by the rules that we've set forth in our operating agreement, we have the ability to either force a sale and or replace them as managers and take over. The other kind of piece of this is we are generally going to be investing in not distressed properties. These are going to be new properties or new acquisitions, I should say, to where it's a new capital stack. We're very conservative in how we underwrite these. We look at a lot of different metrics. Really, the experience of the sponsor group is the highest of importance. And I see one question here. I'll give an actual case study of an example, which I'll give one right now. We're actually about to close this one in a few weeks. So this particular borrower, investor group, they're buying a multifamily apartment complex, actually right in my backyard here in Kansas City. And they are assuming a agency loan. So they're assuming a Freddie Mac loan. I believe it's at 2.94% interest rate with several years left on it. And that's a sweet deal to be able to go and assume yesterday's interest rates. It makes the deal work really well. The downside for them is the leverage point is only at about 45. So the purchase price, if you have the debt on there, you're assuming it, you have to raise 55% of the equity. That's a lot for a real estate investment generally. So what we're doing is coming in as preferred equity, sitting behind the agency lender. We're bringing up the overall leverage, so to speak, to about 55 to 60%. So we still have a lot of equity that's covering us. They have to go raise all that equity from their investors, and they all get paid back only after we get fully paid back. And in that scenario, they're getting a great price on it. They got great debt in place on it. They're a vertically integrated team, which means they have construction, they have property management in-house, so they can do all this with their own teams. And they've got a great track record doing this in several properties. So to me, that's a great example of a deal to where we're coming in, we're filling that middle part of the capital stack. And based on how we structure our returns, it's actually going to benefit their investors. Their investors are going to make better returns by bringing us in, and they have to raise less equity. So that's the kind of win in this scenario.
And then the next question we have, who is usually investing in the private credit funds? And there's a couple layers. One is, speaking of that myth, there are institutional and big partners who they love that product. And again, why they love that product? There's a couple of things. One is it's a risk-adjusted return. So they want to earn more, but they want to inherit less risk possible. And this is the second position when you get double-digit return, but you still have a rights. You might not have a collateral direct to property, but you do have a special terms and the rights. It's better than nothing, like common equity investors on top, sitting on top and taking all of that risk. And if God forbid something happens, they usually get wiped out. And we discussed that multiple cases right now when they're going through tough financial times. And at the end of the day, who's losing all the money? It's like common investors, because they sitting on top of the capital stack. That's the first option. It's going to be a lot of institutional, different hedge funds. They love those products because they get better return. They can push their portfolio to the better performance when they start to blend that average return of different investment products, and they still get that security, a peace of mind. So secondly, it's retail investors. Again, the larger retail investors love that product for that same reason, because you look at the capital stack, they want to be in the middle, they want to have a cushion. Not to say banks like that sometimes. I'm not saying it's perfect situation for a senior debt, but if they got somebody on top, and those people will be ringing the bell first. If the project going through challenging time and you got this mess debt, so that partner is going to come down to senior debt and say, listen, we're in the trouble right now. We need to do something with the deal. And for the senior debt, that's a cushion. They got common equity and this mess debt or preferred equity position. And this is the partner who is going to be ringing the bell and actually doing the things, and actually will be executing not to lose the capital. And that's another layer of security if you look from that point of view. And again, a lot of retail people love that product for the purpose of just double-digit return and less investment risk. So next question, who should absolutely not invest in the private credit fund? Ben, what do you think? That's a tricky one.
That's a tricky question. People that are more risk averse, this is not necessarily going to be all secured investments. So I view this as a complement to an equity portfolio. If you want more security, a true debt fund that has secured debt investing is out there as well. Those are usually lower returns, But again, it's trade-offs for a little bit more risk you're getting. But at the same time, I also think anyone that's not that familiar with investing in private markets, you got to understand what you're getting into, because we have liquidity in this fund, but it's not guaranteed. And I think that's a really key point, that we'll do our best to meet those liquidity requirements. In our other funds, we've done a very good job managing liquidity as it's needed, but it's not guaranteed, and it shouldn't be relied upon like a money market, right? A lot of people think, oh, I'll just put my money here and double-digit returns and then just get it out whenever I need it. That's really what a bank is for, what money markets, CDs are. So you want to understand there are still some risks, not only on the investment side, but on the liquidity side, that you want to be sure you understand, and you're not relying on this you have to have the money back at a certain time, by a certain day. You got to have a little bit more flexibility with that in something like this.
Thank you very much for clarifying that. And I want to talk, there's multiple questions, but I want to talk about the people who love stocks and bonds. Like they probably 90% of the time, that's something they started with. And 55% of the time, people never move to something else. But again, it's just my general observation. So what I'm saying is, what's going to be the advantage of that credit fund compared to the stocks and bonds portfolio when you have that control and you know exactly what's going on? It might be going up and down, but you can log in or you can sell it. What's going to be the advantage of credit fund from the standpoint in comparison of that regular stock market, equity markets? What's going to be the best thing for them to say?
I'm not an advisor, so I can't give any advice, but it's really, every person has to understand what's their goals and what's best for them. My approach has generally been have a balanced portfolio. It's great to have some exposure to stocks and bonds, but you don't want to have all your eggs in that basket. And if I study a lot of the ultra wealthy, generally they have about 50% of their investments in public markets and 50% in non-stocks and bonds, in private equity, in real estate, in debt. And that's generally what I've seen over time. So the higher net worth you are, the more you can invest in these types of investments. But I think at a baseline, if you're accredited, having some exposure to alternative investments like this is really valuable for your portfolio, with consistency of returns, getting cash flow. It's way above market what you can get in the public markets, and just kind of creating true diversification. And especially with something like this, where it's private credit, where it's less risky than common equity investment in a pooled kind of fund, you get a lot of the benefit of both of those worlds.
Excellent. Yeah, that's great. Great point. So I think that lastly, I would say we want to talk about maybe why would the people who's actually getting the money from the fund, why would they go with that type of financing? Because it's a lot more expensive for them to go through the private credit funds than just to go in directly to the bank. And I'll start to respond to that question. One thing we've found out for sure, and we discussed that multiple times, and multiple people ask us the same question over and over again. I think timing is a huge issue, because if you got a good deal and you want to buy it, and again, usually it's a term, then the biggest term is the timing. You want to get the deal, do it in 30 days, 60 days, 90 days, you name it, what's the term is. But again, so usually it's constrained, the time frame. And then people, when the good deal does not need advertising as much. Why? Because a lot of people going after that. And the ones who win, it's the ones who have an access to the fast capital, through more flexible capital. And then that's where the private credit, I want to say it multiple times, private credit, not the institutional credit, but private credit comes in play. Why? Because it's a lot more flexible. It's maybe sometimes a lot more based on relationships. They trust the partner who's actually issuing that credit to you. Because again, there are some bad intention on the market as well. And they choosing between 3-5 different partners, and they never seen somebody. And then because of the Aspen's fund's been around, they have a great reputation. So they say, oh, you know what, we want to go with band and want to go with that private credit fund because we know their intention is not bad. It's actually good. We want to help you with the funding so you can get that deal and you can operate that deal. We don't need to be taking over that thing. And this is not a business model here. Maybe you got a couple more things. Why would they go with why would they not go with cheaper, just institutional classic?
I think you hit all the points really well. So the only thing I would just add to that is the cases like the loan assumption deal I mentioned, the Freddie Mac assumption, where they have to raise a lot of equity. We're actually cheaper than their equity investors. So it's expensive from a bank standpoint, but in those situations where we're kind of competing against the common equity and we're taking a little chunk of that from them, it actually is a benefit to them because they can produce higher returns to their investors because we're cheaper. So it's called being accretive to the common equity. The big thing is relationships. We've got a great reputation in this space as being a good partner. We've never not closed on a deal that we committed to. We have a 100% close rate. So there's a lot of confidence in being able to get the money in, which is a challenge for a lot of people of being relied upon. I tell a lot of the people we work with, I'm not going to be the cheapest capital you're going to get, but I'm going to be a really good partner and I'm going to be really helpful to achieve your goals as long as it meets our parameters. And so people value that. So we have a lot of repeat kind of borrowers and sponsors that we invest with because they like working with us because of the relationship side of it. And man, maybe they could go get a little bit cheaper with somebody else, but they expose themselves to a lot more risk with unknown players that they don't know what their intentions are. They don't know if they're trying to take back the property. This is an end around way. So you're exactly right, Igor. You hit the right on the head.
Lastly, I want to talk, I think this is just the last question, because again, there's some confusion between the target net total return, if you remember that slide when we're talking about the projections. And then there's second option, which just says a target net cash yield. You just give us 30 seconds of understanding. So what is the difference between target net total return and target net cash yield?
Yeah, the total net return includes the cash yield, but it also includes the increase in the value of your account based on the returns that we've earned as a fund, but we haven't got paid in cash for. So if you want to look at what I'm actually going to get in distributions in cash every month or every quarter, that's the cash yield number. But what am I going to earn in total, including the cash yield? That's your total return number.
I got you. If you guys have any more questions, if something was not asked or discussed, please choose a comfortable date, connect to us, scan the QR code on the screen, and then we'll discuss your investment goals. And it's going to be a pleasure for us to talk to you about your future goals and challenges. So the bonus for attentive listeners, remember you guys, send a code INVEST to invest@avistafund.com, or you can use the Telegram as well. It's one of our managers of the fund, and she's going to be happy to send you some bonus. What is that going to be? It's going to be a spreadsheet calculation on 100,000 based. You will see your cash flow, and it's going to be absolutely clear what you're going to be earning right through the investment period. And feel free to ask any questions by email, chat, Telegram, whatever you guys can get a handoff. So we want to wrap it up. Ben, thank you very much for connecting. It was just absolutely amazing. So we went a little bit deeper into the what is that actually, the private credit fund. And if you guys want to find out more, if it's your type of investment, please connect to us. And do you have something else to say, Ben?
No, appreciate it. Thanks so much for sticking around. Hopefully it was helpful. Really excited to work with Avista Fund and Igor and his team.
Thank you for everybody who's attended. Ben, thank you for connecting, and peace and love. You guys stay safe out there. Thank you. Bye-bye.